Hi, everyone. I am Britt Burner, and I'm here to talk about income eligibility for Community Medicaid. Specifically, I'm going to be diving into pooled income trusts. I know there's a lot of questions. I see there's some questions that have come in already before we started the webinar, so I will incorporate the answers to those in what I'll be discussing. And I also got some questions in advance that I will be doing as well. So these will all be addressed as we go along, but as Liz said, please feel free to write questions into the box below and we will address those. So I want to start by discussing what income is. So I talked about this last week when we were talking about Medicaid eligibility, and what it is all income, earned or unearned, wherever it comes from. So you want to think about what that could include. It could include Social Security payments, pensions, retirement plan distributions, dividends from investments, rental income if you have a property that has a two-family where you're renting out part of it, or a second home that's rented out. These are all sources of income. And so what we look at when we are determining Medicaid eligibility is what are all these sources of income? And what does Medicaid consider too much income? And then what do we do with that extra income to make sure somebody can still receive services? And that's what we're going to be talking about today. So I want to give you an example of an income calculation and how we determine how Medicaid is going to look at income. Medicaid says you are allowed $875 a month of income, plus a $20 disregard for being over 65, blind, or disabled. So obviously for many people, $895 a month is not going to be enough to stay at home, pay their bills, and maintain themselves in their home. So any income that you have over that amount, what we need to do is protect it so that you can still receive those services, but also have the use of your monthly income to continue to pay your bills. I'm going to share my screen right now and show you a sample calculation of a fictitious client and how Medicaid will look at their income. So for example, this client has $2,200 of Social Security, a $465 pension, and this is monthly amounts, $275 from a retirement account, we're going to say it's an IRA in this instance, and $80 of dividends. This may be for stock that they have. Some people have a few pieces of stock that was associated with a life insurance policy, or if they have a trust that gives them income, this could be the income that comes out of that trust from those assets. So in this case, we are counting gross income numbers. So this is before anything is taken out. So these are all gross numbers. This person's total monthly income is $3,020. We then take off the $875 that you're allowed to have, the $20 disregard. In this case, this client has a $300 supplement, a Plan F or a Plan G if it's a new plan, for their Medicare supplement. Some call this a Medigap policy, and that is their monthly payment. And then $144.60, that is their Medicare Part B premium. Now, a lot of people don't realize what that $144.60 is, because what they're seeing is their $2,200 Social Security is decreased by $144.60 per month, and then the balance is what is actually going into their bank account because it's taken out right off the top. So in the end, this person's excess income, according to Medicaid, is $1,680.40. So the way this works actually is that the money is deposited, those four pieces of income are deposited into the person's account each month. And then the $1,680.40 is then transferred to the pooled income trust. The $300 that is in that bank account will go to pay that insurance premium, and the $895 will stay and be added to the $15,750 in resources that that person is allowed to have in that bank account. So the $1,680.40 goes into the trust by either an ACH withdrawal. So certain pool trusts will allow you to set up an automatic withdrawal. So if your deposits come in by the 10th of the month, you may have the ACH go out a few days later, or you can actually send a check to the trust and fund that every month. So now, in order to, once the money goes into the trust, then the questions come up. What trust do I pick? What kind of trust is this? And we're going to go through that now. So a pooled income trust is a trust that is created by a 501c3 charity that is meant to take in the assets of a person seeking eligibility for government services, protect that piece, those monies, and let that person qualify for government benefits. So this is not the type of trust that we talk about when we talk about advanced planning, when we talk about planning that has to happen for moving assets out of someone's name for eligibility. This is only a type of trust that is used on a monthly basis for that excess income once someone is applying for receiving Medicaid services. So the mechanics are, it goes from the regular account to the pooled trust account. And it's I like to call it a use it or lose it system. So each month, the money will go into the trust and it will accumulate from month to month. So if $1,680.40 is going into that trust every month, and you don't use the whole thing, and say the end of the month comes and there's $1,000 left, the beginning of the next month, that $1,000 will still be there. It will accumulate. But at the point of death of the Medicaid recipient, the money left in the trust will go to the charity and it will be lost to the family. So this is the money we like to use first to pay all of the bills. I see we have a question at the bottom, which is, does the cost of living factor into the calculation because of a high cost of living for Long Island? And in this case, there is no cost of living adjustment. So the $895 amount that remains in the bank account is the same amount no matter what part of the state you live in. But because the rest of the income, regardless of how much your income is, can go into the pooled income trust, you can still use that income to pay your expenses. So it goes into that trust, and there's no limit on how high it can get. So if you keep depositing monthly amounts into that trust and you never spend the money in the trust, there's no penalty on that for you. The only penalty is that at the time of death, that money is lost. So there's no limit on how high it can go, but you don't want it to keep going up and up because then that's unused money. And most people in these circumstances are living on their income and they need that income to meet their monthly expenses. So what can we use it for? You can use it for rent, mortgage, maintenance, taxes, utilities, cable, electric, anything for the benefit of the individual recipient of Medicaid, for the beneficiary of that trust. We have clients who sometimes, if they have a high income and so they're trying to use that every month to work for themselves, they can plan a funeral and they can pay towards that funeral on a monthly basis. They can pay for additional care beyond the care that Medicaid provides for them. So as an example, if Medicaid provides, say, 10 hours a day, but you really want 15 hours a day, you can pay for those additional hours with the pool trust. You cannot pay for hours that Medicaid is providing to you, but you can pay for additional hours. You can pay any attorney's fees that may come up. You can pay for a geriatric care manager. You can not give gifts. So I think that's a really, a question that comes up a lot is, can I give a gift to my grandchild for their birthday out of the pooled trust? And you cannot do that. So the trust is a company that administers this trust. It is a 501c3 charity. There are many in the state, and I'm not going to talk about the specific names of trusts. That is a very specific thing for you to decide when you're determining which trust to use, but I am going to give you information about how some of these different trusts run and what the kind of fees and processes that they have are, so you have an idea of how it works. So I said that every month that excess income, and in my example, it was $1,680.40, goes from the regular bank account to the pooled income trust. Then there are administrative fees for the trust. They have to pay somebody or pay a staff of people to make sure that the money's taken in and your bills are paid on time and everything is done properly. And so that is a big difference from trust to trust as to how they charge fees. So just as one example, we have one trust that I know of that doesn't have an initial startup fee. They don't have a monthly fee. But every year at the beginning of the year, there's a $900 annual fee. So that's the only fee, is $900 annually. But that trust limits that you can only use 3 checks per month. So if you want them to pay your mortgage, your cable, your electric, and one other bill, you now have to pay for that 4th check. And I believe it's $10 per check. A different trust has an initial establishment fee of $250, so to start the fee, to start the trust, to join it. And then there's a $100 annual fee, and then they charge a percentage of the deposit that you make every month. But it can't ever go above $200 per month for that fee. Then yet another one that we know of has a startup fee of $250, but then they have a monthly fee of $25. And I could keep going. There are many different trusts. The important thing, and the really important thing for clients to notice, is when you're just like any other product that you purchase or service that you engage in, you have to figure out what the cost benefit is for you of those services. Many people will say that the ones that cost less money or the lowest amount of money don't have the greatest amount or the best level of customer service. So if you're a person who needs a lot of hand-holding, who needs a lot of different services, who wants online pay, who doesn't want to send everything by mail or by fax, then it might be worth it for you to pay a higher administrative fee in order to get those services. And that's, again, is going to be a case-by-case determination of what are the costs associated, can I afford it, and what services am I paying for to get those costs, and then determining which trust is the best trust for you. For the trusts that do have a little bit of a higher fee, what I will say is a lot of times that the best resource to answer questions about the trust is someone who works in that trust, a client representative who works at the pooled income trust, at the charity, who's the administrator, can best answer a lot of those questions. There was a question about how you actually have your bills paid. So if you, for example, have a utility bill that comes in, your Con Edison bill, and you want to get it paid by the trust, depending on the type of trust you use, you could either upload it onto the computer with an app on your phone or with an app on the computer and upload it right to their system. In other cases, you can scan and email it to them if you have the ability to do so. You can fax it, or you can send it regular mail. and there's a disbursement form that you fill out, and you say, this is my bill, and I want that bill paid by the trust, and you ask them to make that disbursement for you. The trust cannot give you cash, and it cannot, I said it can't give gifts, but the cash is really important. A lot of people don't realize that this is not where you're getting your day-to-day spending money. Now, you may have situations where you put your day-to-day expenses on a credit card, and you could submit that credit card to be paid by the trust, but you also then, in many times, need to submit the receipts for those daily expenses along with that credit card bill. So that can be a lot of record keeping. So a lot of this is determining what your bills are, what your excess income is going to be, and then what is the most efficient way for you to use that trust. Most often it's paying the biggest bills first. So in my example, $1,680.40 is going into that trust. Well, if I have monthly rent of $1,500 a month, one of the easiest things to do is to have that trust pay my rent, and then I've taken a big chunk out, and it's only one bill, one piece of paper that I have to send in order to get that bill paid. And so that makes things a lot easier for people. Important to know is that what Medicaid checks every year when you recertify for Medicaid is that you have made your deposit of the $1,680.40 every single month to that trust, because Medicaid requires that you meet the spend down. That meaning they say you have too much income. You can either give them that income, you can spend it towards your medical bills, or you can put it in this trust and use it for all your other expenses, which is what most people are choosing to do. So you have to prove to them with a verification of deposit that those deposits have been made every month. The trust, on the other hand, is audited periodically by the government, and they have to prove, in order to keep their status, that they are following the rules and the guidelines by law that they have to, such as only paying expenses for the benefit of the individual who's the Medicaid recipient, who is the beneficiary of the trust, and paying for or not paying for the certain expenses that the government allows them to pay as a verified supplemental needs trust. So they have to be, when people submit things to a trust and they get a little frustrated that the trust can't pay certain types of bills or needs certain documentation to pay certain bills, realize it's because they are being audited and they have to make sure that they're complying so that they can keep their status and keep running their pool trust. Another really interesting thing that we're starting to see, and I know a trust that uses it, and again, I don't want to use trust names, but one of them uses a prepaid card. So they allow you to load the card up with money. So if my $1,680.40 is going into that trust every month, I may choose to put $750 of that amount on this prepaid card. And that card can allow me to do a few things. One is it can allow for auto pay of bills. So I can go right onto my Con Ed website and I can put in for auto pay and let that card pay the auto pay. And same for my other bills that allow for that. Also, if I'm going out and I'm going to the grocery store, I'm going to a pharmacy, I'm getting takeout, I'm taking an Uber. These are all things that can be paid with that prepaid card. And it minimizes, again, that amount of paperwork that I have to be providing to the trust every month. Very specifically, that card and the trust cannot pay for tobacco, firearms, or liquor. So if that was your intention for the card, you're going to be out of luck, and they're not going to pay that expense, and the whole thing's going to be stopped. Actually, they won't pay the whole transaction if those items are included. So again, this is not a debit card in that you can't get cash with this card because they're not allowed to give cash from there. Any cash you need is going to be coming out of your regular bank account that's maintaining the $895 per month and that has your bank balance, that's where you're going to get cash if you need it. But it can prepay certain expenses and allow you to have a card to walk around with without having to worry about keeping every little receipt. I am not sure, I guess, Liz, can we go to questions now? I want to make sure I get to any questions anyone has.
Sure, we've got a question. What was the $20 on the budget?
Right, so the $20 is a deduction that you're allowed to keep an extra $20 if you're over 65, blind or disabled. So it's a what we call a disregard. So Medicaid says you're allowed $875 in income, and then there's that $20 disregard for those purposes, which ends up resulting in you being able to keep $895 in your regular bank account before the pool trust transfer happens.
Okay, thank you. Next question. Is there any annual reporting or auditing done as far as what bills are paid through the pool trust? I believe you answered that.
Yes, that is the auditing that's done by the government of the trust, and then you are accounting to the Medicaid on your recertification every year that you are making those monthly transfers of your excess income.
Okay, next question. If the beneficiary of a trust lives with someone, are they allowed to pay the full rent or only 50% if someone else is in the household?
So technically, the pool trust is paying bills that are in the name of the Medicaid applicant who is the beneficiary of the trust, and they're paying for their expenses. Now, that is going to be a case-by-case determination of how bills are paid when there are multiple people in a household. We do have some situations where our Medicaid recipient contributes towards the bills, but their name isn't on any of the bills, in which case they have to pay what's basically akin to rent to their co-tenant, be it a family member or not family member. In other situations, we can cut the bills in half and split them up that way. And then in some situations, it will be based on, if we can show what bills were traditionally being paid by whom in the household. And we work directly with the trust to make sure that that's done in a way that makes the most sense for that individual and those that they live with.
Next question. Can car insurance and car payments be made by the trust?
Yes, car insurance and car payments, if it is a car for the benefit of the individual and their name is on that bill, then yes, it can be. I want to also add, in terms of transportation, another really interesting thing is, for example, if the holidays come and my Medicaid recipient lives in the city and they take a train out to Long Island to stay with their daughter for the holidays, and that's going to require the train ticket, it's going to require a cab to the train station, and then it also may require paying a home health aide some additional hours to go with that person if it's just for the transportation or for the duration. And the trust can pay those expenses as well. It could pay the plane ticket if that daughter doesn't live on Long Island and she lives on the other side of the country or wherever it may be. So anything for the benefit of that Medicaid recipient.
Okay, next question. My income is from annuities and choose to take it annually, not monthly. Would I be required to change that to monthly? So the short answer is yes. And more importantly than actually changing it to monthly is you're going to be budgeted this way. So even in certain counties, and I will talk about a difference in counties with the retirement accounts actually based on this, but certain counties may let you say, well, I took it for the year, but even if you had, doing quick math, which I'm not good at, $275 a month times 12 is your full distribution for the year that you take. Even if you took it as a lump sum at the beginning of the year, you're still going to be required, when all this math is done, for the $1,680.40 to be transferred into that trust every month.
So it actually is going to usually work out better once somebody is a Medicaid recipient to budget it monthly, because that's how Medicaid is budgeting you. They don't budget annually, they budget monthly. And so they're looking at these numbers divided by 12. Along with that, I will talk about the difference between retirement account distributions. You know, long against, as for attorneys in the state and advocates, consumer advocates, there's a lot of inconsistencies as to how retirement accounts are looked at by the different counties. For example, if you have a retirement account, an IRA, any tax-deferred retirement account, and you live in the 5 boroughs, New York City HRA, who administers Medicaid, says that you take your IRS required minimum distribution, you divide it by 12, and that's how you come up with the amount. If you go to Nassau or Suffolk County, they have a little bit of a different take on it. If you are a married person, it's the same. You can use that IRS amount and divide it by 12, and that's what you have to take. However, if you are a single person in Nassau or Suffolk, they take the position that you have to use the life expectancy chart as determined by the New York State Department of Health. This is an accelerated life expectancy table, meaning that they have your life expectancy as a shorter one than the IRS has, which makes your distributions larger annually and on a monthly basis. So if you are in Nassau or Suffolk and you are a single person, that's how they budget that monthly amount. So someone who lives in Nassau, who has the same exact retirement account balance as someone who lives right over the border in Queens, might have a different retirement distribution amount just based on those factors, where they live and their marital status. And that 275 could go up if this was an IRS number and it was the Department of Health form.
Okay, next question. Can a family member be the trustee for a pooled account?
A family member cannot be a trustee. The trustee and the administrator of the trust has to be the 501c3 charity. However, it is important to note that if someone is not able to submit disbursements or submit bills to be paid by the pooled income trust on their own, their power of attorney can serve as their representative in that capacity and can submit those things to the pool trust on their behalf. So the family member can be in charge of making sure that ACH withdrawal goes to the pool trust every month and that the bills are properly paid.
Can the trust pay credit card balance? Can the trust refuse to pay particular types of expenses?
So for the credit card balance, a trust can pay a current balance, but they will not pay back due cards. So what we usually advise people is, if you're getting to the point where that's your plan as to how you're going to use some of your pool trust money every month, we want to zero out the balance on that credit card before we ask the pool trust to pay anything on it, because they will not pay past due balances.
Can the trust refuse to pay particular types of expenses?
So the trust can refuse. Again, they are audited by the government and they have to make sure that they are complying with federal guidelines. But that being said, regular expenses, so those ones I mentioned are the straightforward ones: rent, mortgage, maintenance, utilities, taxes. These are your regular expenses, and the trust is not going to say no as long as you give them the proper documentation. What we usually advise people is, if you have a larger thing that needs to be paid, say you need a new refrigerator in your home, or you want to do certain home improvements to make your home easier for you to live in. These are the kinds of things where you would want to contact the trust in advance. And I referred before to the different levels of customer service. But if you are going to have a bigger bill, you're going to want to contact the trust in advance, ask them what they require. For example, for construction, they may want 2 estimates just to show that they're paying fair rates. for the large expenses. You're going to want to get, it's almost like a pre-approval, although I don't know that they would call it that, but making sure you're getting them what they need to get that expense covered for you.
Okay, can the pool trust pay my property tax bill twice a year?
Yes, as long as you've accumulated money month to month and the money is in the trust, then yes, certainly it can pay your property tax bill. And some clients do allow it to accumulate. We just, again, want to remind you that if somebody passes away, then anything in that trust immediately is lost to the trust. So you don't want to let things accumulate too much, because we never know when we're going to lose it to the trust, and it might not be there for that next bill.
How far do they look back? How far do they look back your name has been on the bills?
It is just that they're currently, they don't have a look back per se for the names being on the bill. So as long as the bill being submitted has your name on it, they will pay the bill.
The trust will not pay for gifts. Is that just cash or anything else?
The trust cannot pay for any gift. It is a pool trust is a type of special needs or special needs trust or supplemental trust, and it can only be used to pay for expenses of the beneficiary, the direct beneficiary of the trust. So it cannot give any gifts to another individual, cash or otherwise.
Is there a limit to the amount that can be put on the prepaid card?
The only thing that limits the amount that can go on the prepaid card is the limit of what you're putting in the pooled income trust. So obviously in my example, the excess income was $1,680.40, but some people have a higher or a lower. But no, you're only limited to what you have. I'm going to share the screen again, so for anyone who wants to see that calculation as we talk, I can keep answering questions, but at least you can take a look at that, those numbers.
Thank you. I was just going to ask you to do that. We did have a request to put up that example again. The next question,
Great.
Can I set up auto pay for bills from the trust?
So certain bills, this is going to depend on the trust and what bill. So for example, people who have a recurring rent payment or a recurring mortgage payment that's the same every month, we can often set up recurring. If it's a bill that's going to change every month, they won't pay, you can't send the bill to them directly from the vendor. You'll have to submit that bill. So you can't do it if it's a bill that changes, but it's going to depend on the trust individual rules and how they operate. But yes, in some circumstances, we can do that.
What happens if expenses exceed amount in the pool trust?
That's a really common question. And my answer is, if your expenses exceed your income, you have the same problem with a pool trust as you would have if you didn't have a pool trust. You have to find another way to pay your bills. So if you have expenses that exceed the pool trust amount, you can use the $895 that we've left in your bank account. You can use the balance. Remember, you can always have a bank balance of $15,750 or less, so you can use that, and that can certainly be used. But when that question is asked by individual clients to me, I usually say to them, well, how do you cover those bills now? What would you do now if that happens? And oftentimes there is a mechanism that somebody says, oh, well, usually so-and-so chips in, my daughter pays some things for me, and nothing like that would change. But Medicaid is health insurance, so it does not cover your bills. Now, if you're able to get other government benefits because your income and your assets are low, then you might be eligible for food stamps or other benefits, which could help pay some other bills.
Okay, what if my income increases in a particular month, for example, a tax refund?
Right, so we take the position that any income you receive should go into the pooled income trust. I think that you don't want to fall into a category where when Medicaid is looking at your your information after the fact. If they tell you that a certain piece of income should have gone into the trust and it didn't. It's also something that we find is differently applied in different counties. So we take the position that any income that you earn, you should be putting into the pooled income trust.
Can the spouse auto pay the rent for both and get back the half payment into the regular account?
So the trust, that would depend on the situation. Generally speaking, in a case like that, we would look at what the total bills are and we would try and determine how we wanted to split them. But if it's two spouses, I think it would more likely be that we might want to pay the rent in two parts, because we would have to ask the trust administrator if they'd be willing to pay a check to the spouse. It would have to be like a rent situation, as I described, with somebody who's living with others in their household.
You mentioned travel to family members are covered, but can vacation expenses not to an out-of-area family member's home be covered from the trust funds?
Yes, a pool trust is a trust for the benefit of the Medicaid individual, and the money can be used for their benefit no matter what that is. And so if they want to take a vacation, it can. It just can't pay for their daughter to go with them. It can't pay for their daughter's plane ticket. It can't pay for expenses for another person, but certainly can pay for the expenses of the individual.
If you are the spouse, are food bills and everything that is used in the household have to be halved?
The short answer is no, but it's really going to have to be case by case of what all the bills are, and also what the difference between the income of the spouses are. And that's where we really have to work it out and work with the pool trust administrator so that they feel confident that they're meeting their obligations, and also that our clients' needs are being met by the money in the trust. But that's going to be a case by case depending on what the bills are and what the income is for each spouse.
Does Burner Law do pooled trust?
So Burner Law does work with clients to set up pooled income trusts. This is something that we do for most, if not all, of our community Medicaid, home care Medicaid applicants, and we do for others as well. I think that several years ago, we had a seminar, an in-person seminar that somebody came to. Their father had been on Medicaid for years, and they were giving the excess income over to Medicaid every month because they thought that's what they had to do, and they didn't know the pool trust existed. And this woman was very strapped. She was working 2 jobs because she was making up for her father's extra bills because he was giving this money over. And once she came to this seminar and learned about it, we sat down with her, and it turned out that she could have set up the pool trust, and we did going forward. And she was able to pay her dad's money into the pool trust and pay his bills, and it eased a lot of stress on her because she was covering everything for him that the pool trust wasn't covering because she didn't know she could have one.
What is the $300 in your example?
Yes, I should have labeled those. The $300 is health insurance premium. So in my example, that was a Medigap or a supplement to the person's Medicare. So a Plan F or a Plan G are really strong plans, and that's generally what they cost, is around that amount per month. But any health insurance premiums that are out of pocket can be deducted as another expense that stays in your account and that you pay directly on your own and does not filter through the trust.
Can I transfer a savings account balance into the pooled trust?
So there are pooled asset trusts where you can take lump sums of money and put them into the trust. It's actually a different trust than the pooled income trust. It mechanically works similarly, but I'd say if you have questions about that, we should discuss that offline because it's a little bit different, but it's the same concept as this.
What happens to all your other money, like money market accounts or IRA accounts?
So if you have an IRA and you're taking this distribution, which in my example is the $275 per month, then the balance of your account stays where it is, and upon your death, the balance goes to your named beneficiary on the account. Your other accounts, what we do with them is really going to depend on the situation, because remember, in our scenario, this person is applying for Medicaid, which means all their other balances, other than their retirement accounts, have been brought down to below $15,750. So presumably, we have already moved that money either to a trust or to a trusted individual, or the person just didn't have any assets left. But in our scenario, this person is already resource eligible for Medicaid, meaning their assets are below $15,750 plus their retirement accounts.
Once excess income is established, can it be changed?
So yes, it can be, but anyone who has applied for Medicaid or tried to get a budget change for Medicaid knows that it can be time consuming. Every year when you recertify for Medicaid, your budget is adjusted based on whatever your new amount is. Your required minimum distribution will be different each year. Your Social Security amount will change when there's cost of living adjustments. Certain factors may change in this income calculation. So on an annual basis, it is done. If there's a vast change, so for example, if you had a pension and when you applied for Medicaid, that pension was coming, but it ran out, it had a time clock and now it's gone, and now that's $465 less per month that you're receiving, you can apply for Medicaid to rebudget your case, and you give them proof that your income has changed and they can rebudget the case.
Dividends and interest from investments go into pooled trust monthly, but what about interest from bank accounts? $15,750.
So that's a good question. I've never seen, when someone has a checking account with $15,000 in it, the amount of interest, we're talking pennies. I've never seen Medicaid calculate that interest.
Okay, what happens to a pooled trust if I go into assisted living or a nursing home?
So if you go into assisted living, the pooled income trust works the same way. Now, I'm not referring to a Medicaid paid for assisted living. That could be a whole other seminar on its own. But if you're privately in an assisted living, there right there is another example of something the pooled trust can pay for. If you're a person who has a very high pension and Social Security, you might have high income, and that rent at the assisted living might be higher than a standard person's rent, but that's certainly something that could be paid for by your pooled income trust. Or, we do have clients who have very nice family members who want to pay for the assisted living for them, and they can still receive home care Medicaid while living in the assisted living, and their pooled trust, whatever amount it is that's in there, can help pay for their bills just like they could in any other scenario. Your home in that case is the assisted living. If you go to a nursing home, the pool trust is still there. So if you had $2,000 left in your pool trust and you go into a nursing home, you can still spend that $2,000, but now that you're not on home care Medicaid anymore, if you're switching to nursing home Medicaid, there are implications to that. It becomes an available resource and it needs to be dealt with appropriately, but you don't lose it. It's only actually gone when you die.
The next question would be cost of supplement insurance for RX and deductible, like the supplement plan F insurance.
Yes, any of those health insurance premiums that you referred to in your question are health insurance premiums that would be deducted to if there was a Part D, for example, that could come off of this amount as well. So any out-of-pocket health insurance premiums will be deducted from this number.
Okay, last question. Can the $144.60 be deducted from pool?
The $144.60, yes, that is deducted. So really what would happen for most people is when you are seeing the income coming into your bank account, your $2,200 would have already been less than $144.60. So it's $2,200 minus $144.60 is actually what your Social Security deposit in your bank account is. And then yes, that is a premium. So again, that doesn't go into the pooled income trust. I want to thank everyone for all of their really thoughtful questions. I very intentionally left a lot of time for them because I know that this topic really brings up a lot of specific questions. I want to make sure we got them answered.
Last question. Does Medicaid determine the spend down when you apply, or does the trust determine this number?
So the answer is Medicaid determines it. So when you receive your Medicaid approval, it often has a budget attached to it, and it actually says you've been approved for Medicaid and you have a spend down of $1,680.40. Now, when we're applying for clients, what we try to do is calculate it for them and give them the numbers because it's as you see, a pretty straight formula. So we calculate for that. We give them all the backup for that. So we usually know in advance of the Medicaid decision what the answer is going to be. But yes, Medicaid is the one who makes that determination. Great. Thank you to everyone for joining us. And I hope that you have a great week, and we'll see you again soon.